Welcome to Real Estate Secrets Unlocked, the podcast that takes you inside the minds of the industry's top professionals, revealing their top secrets to success. I'm your host, Danielle Damianov. Whether you're a seasoned pro or just starting out, get ready to learn the latest trends, strategies, and secrets that will help you succeed. Join us as we go beyond the basics and explore what it takes to make it in the world of real estate. So buckle up and get ready for a wild ride. This is Real Estate Secrets Unlocked. Hey everybody, it's Danielle Damianov with Real Estate Secrets Unlocked, and I am here today with Jacob Vanderslice. He is co-founder of Van West Partners. It is a commercial investment company, or do you do residential as well?
We still have some residential on the books from years ago, but we're pretty much exclusively self-storage.
Self-storage. So they do a lot of different things in self-storage, and I'm really excited for him to be on because it's the first person I've ever had on that talks about self-storage and investing in self-storage. So this definitely is going to be a good one. But Jacob, why don't you tell us a little bit about yourself, about the company, how long you guys have been around? I know you're based out of Denver.
Well, I'm glad you were your first self-storage guest on the podcast. It's the most exciting thing in real estate that you've ever heard of before. So get ready to have your socks blown off.
I'm ready.
Yeah, we're based out of Denver, and we've done a lot of real estate over the years, real estate types. We got in the business way back in 05, 06. And we did our first storage deal in 15. And it was, at the time, it was kind of a, let's try it out, see how it goes. It wasn't really a fundamental pivot into a new strategy. It was more just like anything, people fall into new opportunities, and sometimes they work, sometimes they don't. If they work, you keep going. So we kept going, and over time, we evolved to being primarily a self-storage owner-operator. We do some development, but most of our deals are value-add existing facilities. We've got 38 properties right now. We bought a few this year. We sold a few this year. And those comprise about 19,000 units, just over 3 million square feet. And the average deal type we target are deals that are just inefficiently operated. Maybe they don't have a website, they don't advertise online, their rents are below market, their expenses are above market. And most of our value creation strategy comes in via our management platform. We self-manage everything. And every deal we buy, we target just growing NOI over time. So that's what we're up to.
Wow. So where do you find your deals? Because you're not just you're based out of Denver, but I'm assuming your deals are all over nationwide.
Yeah, we're all over the country. Regrettably, we only have 3 deals in our backyard here in Colorado, and that's just because the market's tight. It's hard to find opportunities that make sense. But we're in the Midwest, Southeast, Southwest. We've got 1 deal in California that we've had for a long time, but we're otherwise not targeting much out there. Deal flow is challenging. Just like this kind of transcends all asset classes right now. There's a wide bid-ask spread, whether it's a single family home or a multifamily deal or a self-storage facility. Sellers won't think their properties are worth more than maybe they are. Buyers want to pay less because they're looking at their spreadsheet saying, oh man, my interest rate's a lot higher than it was a couple of years ago. I can't pay the price you want. So that a lot is transacting. Most of our deals, almost 70%, we source off market, either direct to seller or through broker relationships. We'll occasionally buy deals that are kind of marketed but inefficiently marketed. If the deal's efficiently marketed, we can almost never compete. If it's marketed by a national self-storage brokerage outfit, we certainly put our hat in the ring, but we'll miss those deals by large orders of magnitude relative to what somebody else will pay.
So let's talk about the way your company, I guess, is structured, because, if do you have people out there searching for deals on, online, or how are you finding those deals and acquiring? Are you using like LoopNet and CoStar, like those types of things, and do you have a team of people looking? Because honestly, that is the most challenging in any real estate, whether you're a solo agent or you're a team or you're dealing with commercial. Finding the deals is the hardest part.
It is. We've got 5 full-time, talented, intelligent people on the acquisitions team, and all they do is look for deals, talk to brokers, underwrite deals. This year, we have looked at 882 deals.
Wow.
and we've closed on one so
Oh,
far.
wow.
So that's a very wide funnel at the top and very narrow at the bottom. We've got 2 or 3 in the pipeline that we're going to be closing this quarter in Q4, maybe more. So it still could turn out to be an okay acquisitions year. But a lot of what they do is not only underwriting deals, but also building relationships with brokers. Brokers, they want surety and they want an easy transaction, right? And if you can perform and not retrade and do what you say you're going to do, they're going to bring you the next deal they get as well. They can avoid going through the widely marketed process and the call for offers. If we can hit the guidance that their seller wants and we go under contract and we close, they'll bring us the next one. So that's performance is really important. That if you don't perform, that broker's not going to bring you the next deal. We spent a lot of time curating those relationships with our broker relationships for sure.
So when you are let's just talk like a lower end self-storage facility and then a higher end or higher, I'm talking about units, what would you say on the low end, how many units you acquire, and then on the high end?
Yeah, we mainly look at when we're thinking about metrics as far as deal size goes, we're typically looking at dollars and square feet. Units can kind of vary. You might have a large square footage facility, but the unit count's low because the average unit size is pretty high. Maybe it's more suburban and more of the units are 10 by 20s versus 5 by 5s. But I would say the lower end deal that we'll typically look at is maybe all in at $3 million. That's probably roughly 30,000 net rentable square feet, somewhere in there. We'll look at stuff that's smaller if there's a reason to look at it. Maybe it's a mile away from something we already own. But as you know, let's say you're originating a loan for somebody, whether you're doing a $5 million loan or a $500K loan, that loan takes the same amount of your time, pretty much, right? Yeah. Sometimes a $500K loan might take more than the $5 million loan as far as your time. So we try to be careful with time. I mean, it's still getting the bank loan, it's still doing all the third-party reports. And if a deal becomes kind of too small, it becomes just less efficient for our load. On the higher end, as far as square footage goes, we have some deals that are 150,000 net rentable square feet. Our biggest single asset in terms of dollars is a development project that'll be done probably in March, which means, May, right? That's development for you, or later. We have never delivered a project, by the way, on time and on budget. It's always one or the other. Even a tiny fix and flip, I don't think we've ever gotten done on time and on budget. Yeah, just always happens. But that one's all in at about 25 million. So okay. that's kind of the range. Yeah. There are some storage deals in the country that, downtown Seattle, they're massive. They're in whole dollars, they're a lot higher than that. But one of the problems with self-storage among many is if you're, let's say, a large institutional buyer and you want to get scale quickly, generally single self-storage deals in dollars are relatively small compared to like a $150 million apartment community. So it's a lot of deals to get a meaningful amount of dollars deployed.
So what is the ROI? What are you looking for the ROI to be for you in order for you to move forward with that deal?
Well, when we talk about returns, there's kind of two return metrics that we express when we're either raising capital for a deal or for our own internal financial modeling. One of those returns is IRR, or internal rate of return. And I'm sure a lot of us listening have heard of that before, but to touch on it briefly, IRR is basically, it's a return metric that accounts for time. It's based on a time-weighted series of cash flows. So it's almost like annualizing a return on investment. So if you do, say, a 10% ROI in 6 months, you might say that's a 20% IRR, right? 10% half a year times 2, 20%. So IRR is one metric we look at. And the second one we look at when we're expressing return targets is multiple. And multiple purely means how much money did you put into a given deal and how much money will you get back as a percentage of your original invested capital you put in. So if you put $1 million in, you try to get $2 million back, that's a 2x multiple. $1 million in, $1.5 million back is a 1.5 multiple. And where multiples kind of get weird is a 1 multiple means you broke even, and less than a 1 multiple means you lost money. So we try to avoid those as much as we can.
And what is the time frame you're looking at that?
So multiples and IRRs, we generally, on deals that we're looking at today, we underwrite about a 5-year hold period. And for the most part, we're targeting IRRs in the mid-teens, maybe 14 to 16, somewhere in there. And multiples around at 2. So if we buy a deal today, and we put $1 million in equity into that deal, we're targeting getting $2 million in equity back by the fifth year. So those are return targets right now. And all of our return targets are wrong, right? We're making predictions and assumptions on financial events like net operating income and cap rates that are 5 years away. So deals always go better or worse than the model says it will. It never goes exactly like you think it will. Generally, we're wrong in the right way. But those are all targeted returns. So mid-teens and 2 multiples roughly.
Got it. So let's talk, and this is funny because where I live in Southwest Florida, there are self-storage units popping up everywhere, like literally everywhere, and they're new construction. So there will be like one here, and then a quarter mile down the road, they're building another one. Same thing with car washes. There's car washes everywhere. In fact, they did like a moratorium on car washes. Like no one else can do any more right now. That's how many there are. So why would someone build? Like, to me, it seems like such a huge cost. Maybe it's not though, because there's not a lot of like, there's infrastructure, but you're not like doing walls and all this other stuff. But why would someone build a self-storage facility instead of just buying one and doing a value add? And like, I would feel like the returns would have to take much longer because the cost to construct is so much more, especially unless they're like the people that own this self-storage facility that they're building also owns the other one around the corner. I don't know, but they're literally popping up everywhere. So what would be the benefit of constructing?
Well, I'll touch on the last comment you made in those questions. So the reason someone might build is, first of all, it may not be a good reason. But I guess the reason we build, which also maybe not is a good reason, we only build new deals in markets that are really undersupplied with high rents. So, and the path to revenue on a development project is very long. It can be longer in some markets than others. And I'll give you kind of an extreme example, but the deal that we're building in Southeast Denver right now, it took us 2 years to get that deal entitled. It's going to take us 18 months to build it after we got our entitlements on. And it's going to take us 3 to 4 years to lease it up and stabilize it. So it's a long path to stabilization and cash flow. Now, if you're building though, generally the reason you're building, again, is the market's really undersupplied. There's a lack of new competition. There's a lack of risk of new competition coming online, and competition outside of your normal real estate risks like cap rates, rents, consumer demand, the economy, interest rates. Competition is your main risk in storage. And what'll happen, and by the way, it's a very sub-market specific asset class. So you can't say that, oh, there's too much storage go up in the US, you shouldn't do storage. Well, that's true and false depending on the market you're operating in. So generally what'll happen, maybe in your area, is a market will become undersupplied, and then everyone notices it's undersupplied, and they get the same idea at the same time, oh, let's go build. Everyone builds at the same time, and that market gets supply shocked. So the market might have had 8 square feet per capita before. Now it goes up to 12 square feet per capita. The market's not used to having 12 square feet per capita. So what happens? Supply and demand, rents drop and occupancies drop. And then everybody stops building because their deals aren't leasing up very well. And eventually those units fill up and they stabilize, and the cycle kind of rinses and repeats. So Denver was a great story for supply shock back around 2018. A lot of us had the same idea at the same time. We built, rents and occupancies went down, and eventually those deals filled up. And some years later, it made sense to start building again, which is why we're doing a couple projects. So it's very supply sensitive. But as you drive around and look at all these storage facilities being built, that's probably what's happening in your sub-market. The market became unbalanced, and maybe some of those deals are going to work and some aren't, but a lot of operators saw that lack of balance and that lack of kind of oversupply, and they said, let's build. And maybe what they didn't notice is 5 or 6 other operators are doing the same thing at the same time. They're all going to open up and their rents are going to go down. So development's a risky proposition, and it's got to be the right deal in the right submarket. As to why somebody wouldn't just buy an existing facility, well, pricing, despite what interest rates have done, is still pretty high in self-storage. Cap rates are pretty compressed. I'm sure a lot of us listening have heard of capitalization rates or cap rates. We don't have to go too far into them, but cap rates and values basically have an inverse relationship. So the lower the cap rate, the higher the value, and vice versa. And you might be able to build a development deal to a 7.5 or 8% cap rate, depending on where you're building. But you might be able to only buy an existing facility at a 4.5 or 5% cap rate. And then your plan is to kind of grow rents incrementally over time. So in theory, development's got a greater return target and a greater return potential. But the risk of development is substantial. And the reason we're not doing a lot of development is we're not seeing deals penciled that would pay us relative to that risk profile.
Mm-hmm. Got it. So when it comes to location, and let's just say anybody that's looking to get into investing in self-storage, what are you looking for?
Well, the main metric we look at initially when we're underwriting a deal are what we just talked about a moment ago, which are supply ratios. How supplied is the market? And the market can have a really high supply ratio as long as that supply ratio has kind of been steady for a while. So, for example, we've got a few deals in markets that have 25 square feet per capita, which is a lot higher than the national average. But in those markets, the facilities are 90% occupied, and that supply has been high for a long time. So we're looking at not only where the supply ratios have been, but what the perceived risk is of that supply ratio increasing. Are there development projects in the pipeline? Have people submitted for building permits? Are there concept reviews that are filed with the city? So we look at supply ratios and kind of the risk of new supply coming into the submarket, but we're also looking at, of course, rents. So where are the existing rents on a given deal we might be buying relative to what the competitors are doing? And maybe we find a deal that's owned by a smaller operator, but they don't have a website. They're not efficiently managing their revenue. So we'll identify that deal as an opportunity because their rents are below market. And relative to other competitors, and our value proposition will be we're going to raise rents over time. So rents are another big one. And we also look at housing density and location and,
How important is location?
Yeah, that's real estate 101, right? Location. We avoid deals that are overly rural, kind of out in the middle of nowhere, just because there's not a good story for population growth. But the main thing we're looking for is housing density. We want to see rooftops in the area. We want to see a story for a good business environment. We don't want to see people moving out of that market. We want to see people moving in. So just normal real estate fundamentals, like you might look at in a house or a multifamily, but specifically for storage, we're looking at supply ratios and, of course, rents.
Got it. Yeah, some of the things that have popped up in this area too, and I don't know if you've noticed it in other markets as well, is it's like self-storage facilities, but for your luxury clients that might want to store their cars or their motorcycle or their, boat or, any luxury type of, there's one called Toy Vault, which is just down the street from me. There's another one that just popped up that will, an RV, high-end cars, whatever. Do you see that in other markets, or is that kind of like, niche to Southwest Florida?
No, we do see that. It's definitely niche in general, but it's not just niche to Southwest Florida. We see, they're sometimes referred to as man caves, right? You condo out these units. Maybe people can buy them or rent them, and they put their luxury car in there, or their classic car, or their RV, or maybe they put a wood shop in there or something. So we see that it's kind of a subset within self-storage, but it's definitely not self-storage. It's a different business. Boat and RV parking. Most of our facilities around the country do have boat and RV parking, but it's kind of a secondary revenue stream. We have a deal in Lakeland, Florida, for example, that we've got covered boat and RV parking. We've got other deals that are uncovered. There are product types around the country, all over the country, especially in communities that have nicer weather with HOA regulations, which Florida obviously checks that box.
Yeah.
There's a lot of just exclusively boat and RV storage facilities. It might be interior storage, which is more expensive. That might be covered with like a power outlet, so you can triple charge your rig if you need to. So we have that in our deals, but it's not a primary revenue stream.
Okay. So let's talk about the market, because you've been around since 2005, right? Well, your company. I've been around since 2001. So we all saw what happened in 2005. It was amazing. 2006 was awesome too. And then it was the summer of 2007 was like, well, what just happened?
Yep.
So
very well.
Yeah, it's a fun time. So, we all know also markets are cyclical. And it's funny because I see a lot of these agents, especially 2 years ago when like builders were, people were lining up to like buy new construction homes and builders were turning people away and doing the lotteries. All that was going on back in '05 and '06. And now builders are like, paying 6% commission just to sell. And we're seeing price reduction after price reduction. So I am curious. I have my own thoughts on like where the market's heading, but I'm curious where you see the market heading over the next 2 to 3 years. And we can talk about residential, commercial, like whatever you think.
Yeah, it all kind of transcends, right, asset classes to a degree. But if you would have asked me in early 2022, if mortgage rates go from where they are today to where they are now, where they were in 22, what's going to happen to home values? And I would have said they're going to plummet. And they went the opposite direction, right? They kept going up. And then now you ask me what will happen to home values if mortgage rates go down, which they are. It's been a big drop in the last couple of weeks, and we'll see how low they go and when. But I would have said, maybe they were going to go up, right? More people are going to get in the market. So it could be the opposite, right? You might see increasing home values in the rearview mirror in spite of rising rates, and you might have decreasing values as rates go down. So why would values go down? Well, sellers that were waiting to sell, they don't want to pay off their 3 and borrow at a 7, right? Even though they can make a lot of money, unless they're doing like a big move, like a big job relocation or getting married or getting divorced or some big life change. Those sellers might get back in the market now because they wanted to sell, but they didn't want to pay the freight on a new, much higher interest rate. So that could create more supply. And more supply, what happens? It drives down values. But at the same time, buyers might get back in the game because if you couldn't afford a mortgage at a 7 a year ago, maybe when a mortgage is at a 5.5 or a 6, now your debt to income ratio makes sense and you can afford to buy again. So I don't have any accurate thoughts, certainly, on what's going to happen.
Ball, that's for sure.
No, it's always wrong. It's always broken. I always have a 50-50 on predictions, and I typically pick the wrong one. But I don't think we're going to see an '08 again. I don't necessarily see that happening. But we've been talking about a recession for 2 years now. I've got a screenshot that I saved from a Drudge report from July of 22 with a big red stop sign. Recession looming, rich are shedding assets, cracks in the jobs market. And what happened? Well, nothing, right? And here we are. Now we're still talking about a recession. Jamie Dimon's calling for a 35% chance of a recession before the end of the year. But we've been calling for that for a while. So I don't really have any strong opinions on what's going to happen. Personally, we will welcome a reduction in our overall cost of capital on the debt side. And I think for our business, that's going to spur transaction volume. It's going to get sellers back to selling versus kind of hurrying up and waiting. And I think transaction activity is going to increase, but time will tell. We'll see. And I'd be curious to hear your thoughts too on your incorrect crystal ball as well.
I don't have a crystal ball. I have, no idea. But what I do know is that I see a lot of similar signs that was going on in 21, 22, not so much in 23 that we saw in 05, 06. And then we know what happened in 07. And it was funny because in 06, I was at a real estate investment convention in Atlanta, Georgia, and Donald Trump was on stage and he was selling his real estate investment courses. And then Robert Kiyosaki and his wife, Kim Kiyosaki, and blah, blah, blah. And I remember them saying, the market's going to crash. And I was like, this is October of 06. Like, there is no way. Like, we were crushing it. And then what happened, right, in 07? And so it's funny now because even Grant Cardone is on and he's saying we're going to see the biggest market correction since 2008. But the great thing is that people that welcome that or that made money in that downturn, I mean, we made a ton of easy money, right, in 05 and 06. Like, it was super simple to make $1 million in a year. Now it's, in 08, 09, in 2010, I mean, we personally lost like almost everything. But quickly we saw the opportunity and we started to capitalize on that. And our area had a lot of Chinese drywall and stuff like that. But we're now seeing those builders that were building homes just leave the homes and they're now going into foreclosure, right? And these constructed homes, we're starting to see a lot of that. I pulled stats, 228 listings expired off the MLS in 7 days. We had like over 1,500 price reductions, which means people, sellers are still thinking their properties are valued here and they're not selling. We're having a lot more properties come on the market than what's actually selling, seeing a ton of like withdrawings, terminations. So it's going to be interesting, but I definitely know there's a ton of opportunity for the people that stick with it and see the opportunity. And I actually have a masterclass coming up on how to work pre-foreclosures. And I'm sure you'll start to see maybe some pre-foreclosures in your space as well, and in commercial and stuff like that. So I do think we're going to have a great opportunity for the ones that want to, go after those certain niches.
Yeah. And what's different this time than, leading up to the financial crisis? And I think that the main difference is, and I'm certainly not giving banks credit where maybe they're not due credit, but I think the difference now is a lot of loans that were originated in the last, call it 8 or 10 years. For the most part, those banks did a little better job of verifying that borrower could repay that loan, right? As opposed to like getting loans in 05 and 06, you could be making 50 grand a year and finance 10 deals at the same time. Nobody cared. So you've got a bit more of a healthy debt portfolio in the country, I think, relative to what you had a while ago. But those anecdotal cracks in the foundation, so to speak, like you just referenced, are pretty interesting. Builders abandoning projects, that feels a lot like 08, doesn't it?
Oh my gosh. And I the other day, and his insurance went from 4,200 to 8,400. So, insurance is going up. It's just a lot more expensive.
Yeah, insurance is a big problem in our business too. That it kind of used to be an afterthought as it relates to our underwriting. Not an afterthought, but we plug in a number, it'd probably be pretty accurate. And now we perceive the risk of our insurance premium to be as high, if not higher, as the risk of our property taxes going up. So especially in Florida for obvious reasons.
So if someone wanted to buy a self-storage facility, and my company does them, but I've never financed one, what are they looking at in terms of terms?
So yeah, the debt markets are pretty wonky right now. Thematically, I would say, first of all, leverage is lower than it was a couple of years ago, of course. And the main reason for that is lenders are sizing their loans to a debt coverage ratio. And for those of us listening on what that is, generally lenders like to see the net operating income of the property be at 25% higher than the annual debt service, roughly. Kind of depends on the lender. But if you're paying the same price for the deal that you were a couple of years ago, and your interest rate's now say 7 instead of 4, what's going to happen to your loan proceeds? Are going to go down. So the days of 70% loan to cost are kind of gone for a while. We're seeing leverage in the mid 50s to low 60s on most of the deals that we're doing. And there's a big difference between kind of debt you're going to source on a value add acquisition versus debt that you're going to refinance a deal that you've stabilized with. So stabilized debt, we refinanced a couple deals in our Fund 2 portfolio maybe 2 months ago. And that was 6.64% fixed for 10 years, interest only. The value add deals we're looking at are generally bridge debt. And we're okay with bridge debt today because we're pretty confident rates are not going up. And we're also pretty confident rates are going to go down. So I think bridge debt without prepayment penalties is a better way to finance a deal with a heavier value add component to it. We're seeing interest rates on that product type at SOFR plus anywhere from 2.5% to 4% over SOFR. And SOFR is basically the equivalent of the federal funds rate. So if you're low 5s there, you might be, in the 8s, depending on the loan type, which is expensive debt relative to where debt's been the last, 5-10 years. But relative to the history of debt, that's not too bad. We're all just kind of sticker shock because we got so used to those cheap interest rates for a long time.
I know.
But generally low end rates, low to mid 6s for stabilized deals with term debts and bridge debt, high 7s to 8s, kind of somewhere in there. And
so you mentioned 10-year interest only. What is the term?
So it's a 10-year maturity, no amortization, interest only. And I'm sure you remember this from the the Fed, the Big Short, right?
Yeah.
It's a securitized debt. It's a commercial mortgage-backed security loan, CMBS loan, and all that means is a bank originates it, and the proverbial they tranche it out and securitize it to thousands of different investors, and that's the debt. So the upside to that is it's longer term, it's cheaper, it's interest only, but you've got some heavy prepayment penalties if you want to pay it off sooner than the loan term. But 10 years is kind of the longest maturity that we're seeing in self-storage. It's very different than multifamily or residential. We don't have the agency debt. We don't have FHA, Fannie, Freddie. But I would say the kind of down the middle term is probably a 5-year maturity, 25-year AM, maybe 12 to 18 months interest only. And again, similar leverage to what I described a moment ago. So debt's out there, banks are lending, but getting deals through committee is more of a challenge than it certainly was a while ago.
Yeah, for sure. And I think, one of the things that you pointed on in the beginning, well, not beginning, but a couple minutes ago, we talked about, banks paying more attention, right? Not since '08, like really looking at people's finances and debt to income. And believe me, I closed a loan in like '06, and the guy had like negative money in his bank account, and they closed it. And I was like, I can't even believe this loan just closed. Like, this is crazy. He's got like negative money. Anyways, but there's a lot of commercial loans out there that they don't look at income. They look at DSCR, debt service coverage ratio, right? And if rents go down and people can't afford to make those mortgage payments, right, then I think that's what we're going to see. Another thing on the fix and flips, those people, and I'm one of those people, right, that bought a fix and flip thinking my property was going to sell for this, and we lost like $30,000 on that deal. And those fix and flips, if you're on a fix and flip loan and they're 10%, a lot of them are 10% down or 90% loan to cost.
Yeah. Yeah.
It's a no income verification loan. And if you don't sell it within those 12 months, you can extend the loan, but you're still paying like a hefty, monthly payment on that. And
it's expensive debt. Yeah.
People are not, it's expensive. It's in the 11s, for the interest rate. So I think we're going to start to see some defaults on some of those, commercial type products where they're not looking at income. They're looking at rents or whatever. So
yeah, the easy asset class to kind of trash talk is of course office right now. Office is taking a bloodbath for all the reasons we're familiar with. But we've been talking about and thinking about this concept of a debt maturity wall. So all these loans are going to mature. They've got low interest rates. That owner is going to have to do one of two things: either refinance or sell. And we were kind of thinking this maturity wall would start to create a big decline in values a year ago, and that didn't happen. And we still have deals maturing, but lenders are kind of working them out. Borrowers are extending, they're doing mezz debt, they're doing rescue capital. So I think there's a lot of pent up pain in the system that we're not necessarily seeing yet.
Right.
But if we see a rapid reduction in rates, say from right now to the end of 2025, maybe that pain will get worse through a little more easily. We'll see. But we're watching for some distress carefully. And we're seeing micro distress, but we're certainly not seeing macro distress.
Mm-hmm. Yeah, I think there's a lot of stuff going on behind the scenes that the general public doesn't see. But if you're in the business and you start looking at the market stats and, looking at exactly the numbers and what's going on with the market, it's quite different than what everybody else, kind of sees out there. So anything else you want to touch upon before we go? I mean, this was extremely helpful. I loved talking self-storage because I really was, very interested. I mean, you always hear that it's a great investment. If you were to get into any other investments, and we'll leave it with this. If you were to get into any other investments, besides self-storage, what would you be looking at?
So as I mentioned a moment ago, we did a lot of residential leading up to our first storage deal. And I think workforce housing is a sound business. I think demand for affordable apartment unit It's like the demand for water, right? It's always going to be there. A roof over your head is a fundamental human need. And as the affordability gap in our country widens, and as we kind of slowly shift over time to a nation of renters versus a nation of homeowners, that for rent housing component is going to remain very important. And there's plenty of multifamily deals that are getting beat up out there right now because of debt issues and irresponsible underwriting and just a lack of execution. But workforce housing is an asset class that we haven't been in for a while, but that we know and love. And I think it's always a good spot to park money for sure.
Would you be looking at building? Would you be looking at like buying, and then like some sort of value add or?
Yeah, we talked to a lot of other kind of investment managers in real estate like us. We know a lot of multifamily folks, and some of them are building here and there, but most of them are targeting deals that are not dissimilar to the storage deals that we try to target. Multifamily buildings that have been owned by the same family for 25 years. They haven't upgraded anything. Their rents are below markets, and their plan generally is they come in, they put in $15,000 a door, for example, in capital improvements, and rents might be $1,000, and they raise rents to $1,400 over the next couple of years as they kind of cycle tenants out and create value by growing that income stream. I think there's a time and a place for development in all cycles and all markets, but the risk of development, especially in this environment, I think is materially higher than it certainly was a couple of years ago.
Yeah, for sure. Well, thank you so much for being on. I think everyone got a ton of information. All of Jacob's contact info will be in the end of this video, as well in the description of the podcast. So I really appreciate it. I think this was definitely helpful. I know I've learned a lot, and definitely want to go look at some, self-storage facilities out there and just kind of get an idea as to what they're selling for and stuff like that. So thank you. I appreciate it.
Thanks for having us on, Danielle. I had a blast.
Absolutely. Well, that's a wrap. I hope you enjoyed today's episode of Real Estate Secrets Unlocked. Don't forget to subscribe to our show on your favorite platform, and we would love your feedback. Check us out on social and let me know what topics you want more of. Don't forget to like and subscribe to our channel and our show. I'm your host, Danielle Damianov, and until next time, stay motivated, stay excited, and keep growing in this crazy world of real estate. Thanks for listening to Real Estate Secrets Unlocked.